So today I want to talk about real interest rates. Specifically, I want to talk about the fact that here in the United States right now, we are seeing record negative interest rates. Now, for those of you not familiar with the difference between a nominal rate and a real rate, the nominal rate equals the real rate plus an inflation rate. The idea here is that the nominal measures how much your money is growing, and the real rate measures how much your spending power is growing. Now, here in the United States, currently what we're seeing is a nominal rate about 1.203, but we're seeing an inflation rate of 2.33%, which gives us a real rate of negative 1.27. So when you're investing in these instruments, your ability to purchase things in the future is actually declining by holding these particular instruments. Now, if you're curious about inflation and the calculation methodologies involved there, I think there are some problems there. At a minimum, I think you should understand how they've changed over time and what they're doing with these numbers. Now, you can watch some videos on it by following these links right here. Now, here is 10-year tips. We can see, July 27th, all-time low, negative rates there for tips. Now, this isn't anything particularly new. Here are interest rates for various maturities of government treasuries in real terms for all this year. And you can see, for the most part, this is entirely negative. In fact, the only time you see a positive number on this chart would be in these dates where these blue bars come up here, and that's only the 30 year. So everything but the 30 year has been entirely negative in real terms this entire year. We see some periods here where 30 gets slightly positive in terms of real rates. Now, I also think it's interesting to compare the nominal rate and the real rate. So you got blue line nominal, orange line real rates. Take a look at this period right here. So we see in nominal terms, we see kind of this channel bound interest rate here. It's relatively flat. But if you look at the real rates, especially in that latter half, those are being driven down. So what we see is nominal rates are staying flat, inflation is going up, and the nominal rates aren't responding to that inflation. Saw something similar not too long ago here, not as dramatic, but we see kind of channel bound here, and we see a more of a decline in real rates there. Question, of course, is, at these all-time low negative rates here, what's going to happen subsequently? It looks like real's falling more than nominal, but time will tell if we see that same kind of divergence in rate changes. Now, question is why? Why is the market, lowering rates? Why is our rates going down? Couple of ideas here, could just be like, hey, we're kind of questioning the recovery. Like, we have a recovery, but we're not really sure what's going on here. Maybe this road to recovery is going to look more like this. There's just some uncertainty associated with that. Certainly seeing, kind of some scratch your head in terms of inflation, in terms of jobs and people accepting them, and the unemployment rate. Might also say, look, see, people are just worried, hey, like, we've got, if the growth isn't as good as we think it is, and we definitely are seeing some inflation, maybe we're going to be in a stagflation environment. That is a concern. And last but not least, you get the Federal Reserve, we got central banks all around the world, and simply put, they are manipulating the market to drive those interest rates down. So it may not even be the natural functioning of the market. It's the central bankers, pulling the levers to keep those interest rates lower than they should be if we had a properly functioning capital market. Have some videos where I talk a lot about what the Fed does, a lot about what the central banks do. You can watch those videos if you follow these links right here. That's it for today. Happy trading out there. If you like this video, please hit like, hit the subscribe button. I'm Brian Kozlowski. Thank you so much.